Last week, the Fed raised rates 1/4 point for potentially the last time. So does this mean that the Fed raised mortgage rates? The short answer is no, because the Fed doesn't control mortgage rates. In fact, mortgage rates actually decreased right after the Fed raised rates on Wednesday. How is this possible? Let's find out in this video. So the Fed doesn't control mortgage rates. It controls the Fed fund rate, which is the interest rate that banks charge other banks overnight to meet their reserve requirements. The Fed funds rate affects short-term loans like credit cards that have a floating interest rate that goes up or down with the market. The Fed fund rate also impacts the interest that banks pay you on your savings deposits, which has gone up considerably over the last year with rate hikes. But the changes in the Fed fund rate do have an indirect effect on mortgage rates, sometimes counterintuitively in the opposite direction. For example, mortgage rates started going down the day after the Fed raised the Fed fund rate. That's because the market had been expecting the Fed to raise rates 1/4 point for several weeks and had already priced that into the mortgage rates that we've been paying. When the Fed didn't increase rates worse than expected and signaled an end to the rate cuts, mortgage rates went down, not up. The market is predicting that mortgage rates will fall further this year to 5.6%. The other things that affect mortgage rates are the Federal Reserve's monetary policy, how much debt the Fed is buying, the inflation rate, the pace of job creation, which we'll talk about in a minute, and whether the economy is growing or shrinking. Mortgages actually track the 10-year Treasury rate, which is the rate at which the government issues bonds that take a decade to mature. As you can see here, the 10-year Treasury yield decreased the day after the Fed rate hike, commensurate with the mortgage rate decline shown previously. If you want to get an indication of where the mortgage rates are headed on any given day, the 10-year Treasury yield is the best real-time indicator. On Friday, that rate inverted, increasing about 12 basis points. Why would that happen after the Fed signaled it was done raising rates based on how it is seeing inflation coming down? Shouldn't the 10-year continue to be flat or down? Well, the reason for the change is that on Friday, the Bureau of Labor Statistics released monthly jobs reports, and it showed the economy added 253,000 jobs in April. This was a big surprise, as many indicators were pointing to a slowdown in the job market. The unemployment rate actually fell to 3.4%. This matched a 53-year low we hit back in January. See, a tight labor market is one of the major factors driving high inflation. So higher than expected job growth could signal inflation is not decreasing as much as the Fed thought. The mortgage market is not only pricing in no additional rate hikes this year, but actually is pricing in one or more Fed rate cuts later this year by 1/4 to 1/2 point by some estimates. The fear is that if inflation doesn't come down from today's 5% toward the Fed's target 2% fast enough, then not only won't we get rate cuts, but we might get more rate hikes later this year. For now, I'm happy to report that we're seeing rates continue to drift lower despite the pop in the 10-year on Friday. As of this weekend, we at Knock are quoting customers with good credit 30-year fixed mortgages at 6% and at 5.6% if you buy down your rate by just 1% of the loan amount up front. Let's hope this trend continues as spring season kicks into high gear. As always, please like, follow, and subscribe if you think this made you a little smarter and you want us to create more content like this.
I want for reality.